All right, welcome to another video, and in this episode I'm going to share with you 4 tips on trading the wheel strategy. If you've never heard of this strategy before, I highly encourage you to check out our website, tradersfly.com. There's a ton of knowledge and information there. There's a lot of freebies, goodies, and we also just launched a course on the wheel strategy, so I highly encourage you to check that out. But basically, what the wheel strategy does is it goes ahead and tries to acquire stock at a lower price, and then when you acquire it, you try to sell it at a higher price. And that's the whole point of the wheel. You acquire at a lower price, you sell at a higher price, and you're doing it through the options world. And if you don't acquire it or you don't get rid of it, you get paid for the option side of things. So the way that it works and operates is that I'm just going to show you a little quick example. Let's say I go to Pinterest. I will go and buy 100 shares of stock and give you a little demo here. Once I go in and buy those 100 shares of stock, see, I've got 100 shares of stock. Actually, I've got 500 shares of stock. Okay, so when I have those shares of stock, now what I can do is sell options against it, or call options in this case. So I might go to a few days out. This is 14 days out, and I could sell at 26 and say, hey, you know what? I'm okay to get rid of my stock at 26, and because I've got 500 shares, I can sell 5 of them. And now if the stock stands still, I will collect $74 times 5, which will be a total of $370. But if it does get to 26, because I bought at 24, then I will also sell the stock at a higher price. So that means I make money on the stock and I make money on the options. So that's kind of a great point. Now, once you lose the stock, okay, once you get rid of that stock, you can also sell puts. Let's say I want to pick up more stock at 24. I could sell a put right here to acquire it at a lower or cheaper price. That means if it gets to 24, I get the stock. But if it doesn't, I get to keep the full 48 bucks in this case. So that's the way the wheel strategy works. You are moving things along. So let's get started with a few little tips. I want to share with you tip number 1 is don't choose cheap stocks. So one of the things that most people do is they want to go into some cheap stocks to do the wheel strategy. Now, I'm not saying you can't, just be aware of some of the risks. So here is Robinhood. It's a cheaper stock. It's not to say you can't do the wheel strategy on it. It's just the wheel strategy makes it a little more difficult. I'm not trying to bash Robinhood overall. I'm just trying to say, hey, with a 7-day option, there's premium, or the amount of money you can make from the option side is very slim. It's like $7, $6, and there's not a lot of strikes here. So if you go 21 days out, you have a $21, $22 option, 9-cent option, 4-cent option, and that's about it. Whereas if you do something like, let's pull up Amazon, it's a $140 stock, and this one has, let's look at all the strikes, a 21-day option. Look at all these strikes you could go through. So there's a ton of different premiums. So $2.10 means $210. So there's a lot more involved here. Choosing a cheap stock, even like Pinterest, there's not a lot of option premium there. So take a look. I did Pinterest as an example, but you can see 87, 51, 28, 16, and 9. So there's not a lot there. I have to go further out in time to do that. Going 7 days out, you know, you got a few, but again, not a lot. You have to scavenger for pennies. Choosing a stock like Ford, look at that. It's a $12 stock. 7 days out, you barely make anything. It's almost zero on the options market. So choosing a cheap stock doesn't always work well, and it's not necessarily the best. Let's look at number 2. The second thing is do the wheel strategy on stocks you are willing to stick with for 3 months. Because what happens is let's say let's pull back up Pinterest. Let's say you're doing the wheel strategy, and the wheel strategy is more bullish in nature. Well, if we look at Pinterest here, we might have a losing situation. Let's say we start this over here. Well, we have a losing situation, maybe another losing situation. Maybe here was a winning situation, and now we lost a lot. And then what happens is people get out, and then they try to hop to a new stock. And when they hop to a new stock, then they're doing a new stock, but they're not in here. And this, you would have had a lot of winners, a couple of weeks or months in a row where the wheel strategy would have been fine and worked really well in that case. So instead, what people do is they hop around. Let's say we go to GM. So GM, you might have lost, and then you would have had your winners here. So the point is that, yes, you have some winning zones, but you also will have some losing zones. And if you don't stick with the same stock, you might be hopping in from a loser to a new loser, and that's not good. So think about it and make the appropriate decision. All right, let's look at number 3. And the third thing is you don't need a perfect 100 lot of shares. A lot of people think you need a perfect 100 share lot, but you really don't. If we go into Ford, let's say I wanted to do a covered call on this, and by the way, as an example, you could just right click over here and just go buy covered stock. And now I've got that, and we'll go and send that order in. So once we have that order in, if you go with a full 100 lot size, that's fine and that's normal and natural, because a lot of people want to have 100 shares and then they want to sell the options against it. They want to have another 100. But instead, what we could do is we could actually add to it, because many people are worried about losing that stock. So instead, what we can do is add an extra. Let's go in and buy an extra 10 shares here on Ford while we wait for the covered call to fill. And we'll see if it gets filled here. And having those extra cushions of shares will allow you to ultimately get, there we go, getting something filled, will allow you to get a higher or stronger delta, because when you have a stronger delta, now you don't have to worry about that stock being lost. So here I've got my extra 10 shares right there, and now we're waiting for that extra 100 shares and the call to come in. It's kind of waiting for it around. I'm not sure if it'll get filled here in a second, but really if I put that in there, right there, sell the 100 at, or sell a one contract and buy the 100 shares, that means I'd have 110. And that would allow me to continue to make money as the stock headed higher. That way, I don't have to worry about, hey, I'm going to lose those 100 shares and then I'm not going to be able to make any money. Instead, yeah, it allows me to keep running to the upside, and that's fine. So having that extra 10 could be beneficial. All right, so we'll move on. We'll go to number 4, and that is spread your capital at different strikes and expirations. So if we go back to the Pinterest examples, you can see what I've got is I've got 500 shares and I've got 5 contracts at the 26 call. Now that's not necessarily the wisest way to do this. So we've got 5 contracts, and that means I lose it all at 26 on September 29th. So positioning all of that is not always the smart approach. I'm going to show you a better approach to doing this. And what we will do is construct it in this manner. First, I'm going to try to get rid of those other ones that I have, but I will go in and do a blast all. Let's see if we can do something like this, and then maybe here, and then maybe another one over here, and another one, let's say over here. So, and let's go over here. Okay, so I've got a few things going. Hopefully it fills. Let's see what we've got. So what I'm doing now is spreading the positions. You can see I've got 500 shares. So I'm spreading my positions. I'm going to have maybe in a couple of different calls at different expirations. So you can see there's a few different expirations. And then I have different strikes. So different expirations and different strikes to be able to spread my capital in positions. There they go. Boom, 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 boom. So now I've got a lot of different positions there. One here, one here, one here. That way I don't concentrate all my risk at the 28 or the 26. So by spreading that risk and capital, that helps move that money in different zones and areas. And that way you're not fully allocated in one spot. And that's kind of the risk profile picture that it looks like. So I hope that helps and gives you a little insight on some tips on the wheel strategy. I highly encourage you to check out our website here, tradersfly.com. There's a ton to learn there. There's a lot of great freebies, mini courses, mini guides, and much more. Definitely check it out. And there's other websites that we have where we do some webinars on. So definitely take a look at that, and hope you learn a lot from these videos, trainings, and just gives you something to think about. And if you want to book a free 20-minute call to chat about some things, or working together one-on-one, then also let me know. And it's because it's something I do where I work with people for 3 months at a time or 6 months to really get them to understand what's happening in the marketplace. So thanks for joining me, and I will see you in the next video. Take care.